At some point in the future, there will be a market crash. After all, there's been much talk about an AI bubble, and many analysts now believe that the market is extremely overvalued. But that does not mean that this is something to fear. A downturn is only dangerous if you are unprepared. That's why in this video, I want to show you how you can not only protect your portfolio for the next market downturn, but also put yourself in a position to come out ahead. But before I talk about that, let's first look at how common market downturns actually are. In a typical year, you should expect to see a drop of 5% or more about 3 times. These moves are completely normal, and yet every time they happen, it does not stop YouTubers from releasing yet another round of doomsday videos. After that, a larger decline of 10% or more tends to happen about once a year. This is what we call a market correction. Historically, most corrections are short, and they only last for a few weeks to a few months. Next, a bear market is when prices fall 20% or more. This is far less common, thankfully. Historically, bear markets tend to occur around once every 6 years. The most recent one was between February and April 2025, when Trump was slapping tariffs on everyone, including the poor penguins. Even so, that decline was relatively short-lived, and the sell-off was largely over before most investors had time to feel real pain. In terms of severity, the last truly brutal bear market was from 2007 to 2009 during the global financial crisis. At that time, the market fell by 57% over 17 months and took more than 4 years to truly recover. So, how do you prepare for these kinds of sell-offs? Happy Chinese New Year! Get up to $1,888 in rewards when you open an account with Poems by Philip Capital. To make sure you qualify, take Smart Park opt-in during the sign-up process. From there, depending on how much funds you deposit into your accounts, you will earn corresponding welcome gifts. For example, if you fund a minimum of $1,000 within 14 days and keep the funds in the accounts for 30 consecutive days, you will receive a $10 stock coupon. But if you fund at least $20,000 while executing at least 5 trades, the reward increases to $250. Additionally, the first 50 people who open their Poems accounts on a Tuesday will also receive an additional $50 stock coupon corresponding to the company for that week of sign-up. For example, signing up in the second week of the promotion will qualify the customer for one $50 P&G stock coupon, whereas another customer who opens the accounts in the third week will receive a $50 Microsoft stock coupon. This is on top of the $0 US commission for 30 days reward when you fulfill the terms and conditions. So if you are interested, you can sign up with my link down below. The first and biggest thing to remember is to avoid panic selling. When market drawdowns are scary, keep in mind that bull markets usually last much longer than bear markets, and they deliver far greater returns over time. This is why long-term investors who stay invested are rewarded even after going through deep drawdowns. Of course, that is easier said than done. It's not easy to stay calm when you see your portfolio drop 10% and wipe out your entire year of savings. So let me share how I think about investing now and how it helps me stay invested even when my portfolio is down by a lot. In investing, there are 2 prices. The first one is market price. This is the price that you see every day. It moves with headlines, sentiments, fear, and excitement. The second price is intrinsic value, which is what the business is actually worth. Intrinsic value is driven by earnings, cash flow, balance sheet strength, and long-term fundamentals. To explain this, imagine you own a farm. Every day, you have this xiaolang neighbor who would come over and yell what he's willing to pay for your farm. Like sometimes he goes, "Oh no, your farm is worth $50 today." Then tomorrow he's like, "Green Bull, let's go. Your farm is worth $500 today." He does not care how the farm is actually doing. He's just reacting to his mood. Meanwhile, your farm continues to operate normally. The cows produce milk, the chickens lay eggs, the business keeps running. This is exactly how the stock market works, and you can clearly see this with real examples. So back in 2022, investors were questioning whether Meta could continue growing. There were concerns around advertising slowdown, rising costs, and heavy spending on the metaverse. And as a result, the stock fell from $380 to below $100, even though the company remained profitable and had great earnings. But then, as cost discipline improved and earnings stabilized, investor sentiment started to come back, and the stock eventually recovered and went all the way to $700. Throughout this entire period, Meta's intrinsic value moved far more gradually, rising from roughly $380 to about $530 today. Back then, if you knew that the company was trading below its intrinsic value, you would have bought at a huge discount and profited a lot when it recovered. Here's another example, Google. Over the past 5 years, Google's revenue, cash flow, and even its intrinsic value has grown steadily. And yet, its share price has gone through multiple sharp sell-offs driven by macro fears, regulation, headlines, and AI disruption concerns. And because of those negative sentiments, the stock was trading well below its intrinsic value. But then, when it was reported that Berkshire Hathaway bought the stock, almost immediately the sentiments improved and prices recovered, even though the business itself did not change dramatically. What this shows is that when you invest in stocks, just because the stock drops in value doesn't mean that the business is deteriorating. In many cases, it simply reflects the fear and uncertainty. As the saying goes, the stock market is the only market where things go on sale and all the customers run out of the store screaming. If you understand this, rather than panic selling, you can take advantage of market downturns by buying great businesses at attractive prices. In fact, even today, there are already strong companies trading at discounts, largely because sentiment is negative. One of them is Adobe. The stock has fallen significantly in recent periods, and yet Adobe has historically grown earnings at 15% to 25% annually. So even if future growth slows to just 10%, the stock would still appear to be trading at an 11% discount today. Another example is Salesforce. The stock has taken a beating recently, but even under conservative growth assumptions, valuation models still suggest that it is trading below its intrinsic value. However, this comes with an important warning. Just because a company is trading at a discount does not automatically make it a good investment. That's why it's important to understand what you are investing in. So that's for stocks. But what if you are buying into an ETF, like the S&P 500 or an all-world fund? In that case, the process is even simpler because you are no longer betting on a single company. Instead, you are buying the earnings power of hundreds or even thousands of businesses at once. In that case, the question is no longer the company is good or not, but rather, can I invest through the downturns? As I've shown earlier, broad markets have gone through huge declines, but they have also recovered every single time. So if we look at the rolling returns over the past 30 years, the S&P 500 has experienced drawdowns of more than 40% over certain one-year periods. However, for investors who stay invested and did not panic sell, those losses will have recovered within roughly 12 to 15 years. And over even longer holding periods, those returns will tend to converge toward about 10% per year. This is also why people often say that the S&P 500 delivers an average annual return of around 10%. So if you're investing your money, you need to ask yourself this question. If your portfolio fell by 30 to 40% today, would it affect your lifestyle or your sleep? If the answer is yes, then your portfolio is probably too aggressive and it may not suit your risk tolerance. In that case, you may need to relook at your portfolio allocation. Here, Vanguard shows that the more you allocate into safer assets like bonds, the lower drawdowns you will see. For example, a portfolio with 60% stocks and 40% bonds has historically experienced a maximum drawdown of around 26%, which is significantly lower than a 100% stocks portfolio. The good news is that for Singapore investors, especially those nearing or in retirement, part of this bond allocation is already taken care of. CPF acts like a bond component. It is stable, capital protected, and provides predictable money income through CPF Life. So if you want to further reduce your risk or increase retirement income, then you can simply top up your CPF. This effectively increases your bond allocation and raises your future money payouts without needing to take additional market risk. Besides bonds, another popular option is the all-weather portfolio, which consists of 30% stocks, 55% fixed income, and 15% commodities. This kind of portfolio is designed to perform across different economic environments, such as growth, recession, inflation, and deflation. And historically, you can see that this portfolio has given a much lower drawdown as compared to the S&P 500. But of course, the returns would be lower as well. So you need to be comfortable with that trade-off. Now, once you understand that stock markets can recover from crashes, the next question is, how do you actually benefit from it? For me, I have two separate strategies. The first one is dollar cost averaging. So with DCA, I invest a fixed amount on a regular schedule, regardless of market conditions. When prices go up, I buy. When prices go down, I cry a bit, then I buy more. Over time, this smooths out my entry price and removes the need to guess when the right moment is. there's also data behind this approach. So what Charles Schwab found was that while perfect market timing delivers the best outcome, I know that this is impossible to execute consistently. So as a compromise, both DCA and lump sum investing performed reasonably well over time. Meanwhile, the worst results came from investors who tried to time the market and got it wrong. This is why DCA works so well. By mechanically buying in periodically, it can protect you from your own emotions. The second strategy that I use is buying the dip. This is something that I do whenever a stock or ETF that I'm investing in has fallen by quite a bit. For example, I just bought the dip the other day after the market sold off due to the whole Trump-Greenland tariff saga. For this, I keep around 5% to 20% of dry powder, aka cash on the sidelines to buy whenever I need it. One option to park this money is in a high-interest savings account, which allows me to transfer funds quickly into my brokerage when the market drops. Another option, if you're already using a low-cost broker, is to hold the cash directly inside the broker. In these brokers, either cash is automatically swept into money market funds, so it can continue to earn a yield while remaining readily available whenever you need to invest. So when I combine DCA with buying the dip, I get the best of both worlds. I stay invested during normal times, and I also have the flexibility to deploy capital when the markets are crashing. In short, portfolio protection is not about predicting crashes, but building a system that lets you stay invested and take advantage of them when they happen. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.